Most of us live with a low hum of financial anxiety. It is a quiet dread that sits in the back of the mind. Will there be enough money? Will people be forced to work forever? This fear is like a thick fog. It obscures the future and makes every financial decision feel heavy and complicated. The world of money seems designed to be confusing, filled with jargon, gurus shouting contradictory advice, and endless charts that go up and down with terrifying speed. This complexity paralyzes people. It makes them believe that building wealth is a game only for the experts, a game they are destined to lose. So they do nothing, or they make choices based on fear, which is often worse. But know this, there is a clear, simple path through this fog. What if the journey to financial independence and early retirement was not about mastering complex strategies or picking the next hot stock? This is the truth discovered on the journey to freedom. Early retirement is attainable, not through being a financial genius but through a simple method followed consistently, without complication. This method does not require a special degree or an insider's knowledge. It requires only discipline and the courage to ignore the noise. The goal is not to get rich quick. The goal is to build wealth slowly, steadily, and surely. This essay is your map. It will show you the exact, uncomplicated strategy used to build a nest egg that allows you to live life on your own terms. We will start by defining a clear target, a number that turns a vague dream into a concrete goal. Then, we will build a portfolio so simple, it only needs 3 ingredients. This is the core of the plan. It is a fortress designed to grow your money while protecting you from your own worst instincts. We will cover how to fuel this plan through saving. Your entire financial future can be built upon a foundation of just 3 simple assets. You do not need to be a stock-picking wizard. You do not need to understand cryptocurrency. You do not need to understand hedge funds. The strategy is to own a piece of everything. You achieve this by using low-cost, broad market index funds. These are mutual funds or ETFs, exchange-traded funds, that simply buy and hold all the stocks or bonds in a particular market index, like the S&P 500. By owning one of these funds, you instantly own a tiny slice of hundreds or even thousands of companies. This diversification is your first line of defense against risk. First, you need a total U.S. stock market index fund. This is your engine of growth. This single fund gives you ownership in virtually every publicly traded company in the United States, from the largest tech giants to smaller, emerging businesses. It captures the overall growth of the American economy. You are not betting on one company to succeed. You are betting on the long-term success of American business as a whole. History has shown this to be a very good bet. This fund should be the largest part of your portfolio, especially when you are young. Second, you need a total international stock market index fund. The world is a big place, and great companies exist outside of the United States. Finally, you need a total U.S. bond market index fund. Think of this as your portfolio's anchor. Bonds are essentially loans you make to governments and corporations. They are generally much less volatile than stocks. When the stock market is plunging, bonds often hold their value or even go up. Their role is not primarily to generate massive growth, but to provide stability and reduce the overall volatility of your portfolio. This stability is what will keep you from panicking and selling your stocks at the worst possible time. Having a great investment plan is useless without fuel. The fuel for your financial independence engine is your savings rate. This is the single most important factor you control. Your savings rate is the percentage of your income that you set aside for investing. While a financial advisor might suggest saving 10% or 15%, that is a plan for retiring in your mid-60s. If you want to retire early, you must be more aggressive. Aim for a savings rate of 25%, 40%, 50% or more. The higher your savings rate, the faster you will reach your goal. It is simple math. Saving more money not only builds your investment pile faster, but it also trains you to live on less, which means your final retirement number will be smaller. The key to a high savings rate is to make it automatic and invisible. Treat your savings like your most important bill. Set up an automatic transfer from your checking account to your investment account for the day after you get paid. The money is gone before you even have a chance to miss it or spend it. This simple act of automation removes willpower from the equation. You are no longer deciding whether to save each month. The decision has already been made. Start with a percentage that feels slightly uncomfortable but manageable, and commit to increasing it by 1%, 2% every year or every time you get a raise. To save more, you must spend less. This does not mean living a life of miserable deprivation. It means practicing mindful spending. You must relentlessly cut costs on the things that do not bring you value to free up money for the things that do, like your freedom. The biggest wins are found in the big three expenses: housing, transportation, food. Can you live in a smaller home or a less expensive neighborhood? Can you get by with one car instead of two, or a used car instead of a new one? Can you commit to cooking more meals at home instead of eating out? A $10 lunch bought every workday adds up to over $2,500 a year. That is $2,500 that could be invested in working for you. Finally, be smart about taxes. Taxes are one of your biggest expenses over a lifetime, so minimizing them is crucial. Take full advantage of tax-advantaged retirement accounts like a 401k, 403b, or IRA. If your employer offers a match on your contributions, you must contribute at least enough to get the full match. It is free money, an instant 100% return on your investment. Contributions often reduce your taxable income now, while Roth versions let withdrawals be tax-free later. You have spent years saving and investing. You have finally reached your target number. Congratulations. Now comes a critical question. How do you turn that pile of assets into a steady income stream that will last for the rest of your life? This is where a safe withdrawal rate comes in. The most famous guideline is the 4% rule. This rule, based on historical studies of market returns, suggests that you can safely withdraw 4% of your portfolio's value in your first year of retirement. After that, you adjust the amount you withdraw each year for inflation. For example, if you retire with $1 million, your first-year withdrawal would be $40,000. If inflation is 3% that year, your second-year withdrawal would be $41,200. It is what gives us the simple 25 times rule for determining our retirement number. If you can safely withdraw 4% each year, that means you need a portfolio that is 25 times your desired annual spending. So, if you determine you need $50,000 a year to live comfortably in retirement, you multiply that by 25 to get your target nest egg, $1,250,000. However, the 4% rule is not an ironclad law of physics. It is a guideline, a starting point for your planning. For those seeking an extra margin of safety, a more conservative withdrawal rate might be wise. Many early retirees now plan around a 3.5% or even a 3% withdrawal rate. This provides a larger buffer against a severe market downturn early in retirement or a period of high inflation. A lower withdrawal rate means you will need to save more money, but it significantly increases the probability that your money will outlive you. The peace of mind this provides can be invaluable. Flexibility is your best friend in retirement. Reducing spending in down years and keeping 1 to 2 years of cash can be a lifesaver. The path to financial independence is not a straight, smooth road. It is a journey with inevitable storms. There will be times when the value of your stock portfolio plummets by 20%, 30%, or even more. This is not a matter of if, but when. These events are a normal recurring feature of the stock market. The worst thing you can do when this happens is panic and sell. Your simple 3-fund portfolio is designed for this. During a crash, you must have the courage to do nothing. Or, better yet, to keep buying as planned. You are buying more shares at a discount, which will supercharge your returns when the market eventually recovers. Another, more subtle risk is inflation. Inflation is the silent thief that erodes the purchasing power of your money over time. The $40,000 that provides a comfortable lifestyle today will not be enough in 10 or 20 years. This is precisely why we invest in stocks. Over the long term, stock returns have historically outpaced inflation, growing wealth in real terms. Bonds, cash, are much more vulnerable to inflation. This is why a long retirement portfolio needs a substantial allocation to stocks. To manage these risks, you need a simple maintenance routine: rebalancing. Rebalancing is periodically adjusting your portfolio back to its target allocation. Example: start 80% stocks, 20% bonds. After a great year, it drifts to 85%, 15%. To rebalance, sell some stocks, buy more bonds, back to 80-20. This enforces the cardinal rule: buy low, sell high. It trims winners and adds to underperformers, keeping risk consistent. Do this once a year. Finally, risk from within, your own behavior. We are emotional creatures, driven by fear, greed. The simple automated plan is your shield. Automate investments to take emotion out of the process. On the journey to financial freedom, the path is littered with traps. The most seductive trap is trying to time the market, the belief you can predict market ups and downs, selling at the top, buying back in at the bottom. It sounds brilliant, but in practice it's impossible to do consistently. Even professional money managers fail at it. The simple path is to stay invested, always. Another dangerous trap is chasing hot stocks or complex investments. By the time you hear about it, the big gains have likely already happened. Speculation, not investing. The same goes for complex products promising to beat the market. They often include layers of hidden fees that eat away your returns. Fees are like termites in your financial house. A 1% difference in annual fees can consume hundreds of thousands over decades. Be relentless in pursuing low-cost investments. The 3-fund portfolio's index funds should have expense ratios around 0.10% or less. Finally, avoid lifestyle inflation. Spending rises to match every income increase. To escape, direct a large portion of every raise and bonus into investments. Celebrate with a dinner, automate the rest into savings. We have covered a lot of ground, but the entire strategy boils down to a few core principles. First, set a simple, concrete goal. Use the 25 times rule to calculate your number. Write it down. Make it real. This is your destination. Second, build with 3 low-cost index funds. Third, fuel it with a high savings rate. Pay yourself first by automating your investments. Fourth, expect bumps, rebalance once a year, and trust the long-term plan. Here is your first step. Today. Not tomorrow. Not next week. Open a new browser tab and set up an automatic transfer. It can be $100. It can be $50. The amount does not matter as much as the act of starting. Start now.